What's up, everyone? Welcome to Trendspector, and I'm pumped to talk about investing with you today. Listen, I know that getting started in the world of investing can feel totally overwhelming. There are so many options out there, and it's hard to know where to even begin, let alone which investments are actually right for you. That's why today, we're breaking down the top 10 investments that are perfect for beginners. Whether you're just starting to build your portfolio or you're looking to diversify what you've already got going, these options are a fantastic place to start growing your wealth. Let's jump right in. Alright, let's kick things off with a bang. Index funds are like the superheroes of the investment world. They match the performance of a specific market index, like the S&P 500. Investing in an index fund means buying a piece of all the companies in that index. It's the ultimate set it and forget it investment. Invest consistently and let compounding work over the long haul. Plus, they're incredibly low cost. Even Warren Buffett is a huge fan of index funds. Now, let's talk about ETFs, or exchange traded funds. They're like the cool younger sibling of index funds. Just like index funds, ETFs offer instant diversification because they hold a basket of assets like stocks or bonds. But here's the kicker. ETFs trade on stock exchanges, which means you can buy and sell them throughout the trading day, just like individual stocks. This flexibility is a double-edged sword though. On the one hand, it's super convenient. You can adjust your portfolio quickly and easily, taking advantage of market opportunities as they arise. But on the other hand, it can be tempting to overtrade, especially if you're new to investing. My advice? Treat ETFs like the long-term investments they are. Don't get caught up in the day-to-day fluctuations of the market. Instead, focus on building a diversified portfolio that aligns with your investment goals and risk tolerance. Now let's shift gears a bit and talk about bonds. Think of bonds like the responsible, grounded friend in your investment portfolio. They are not flashy or exciting, but they are always there to provide stability and balance, especially as you get closer to retirement. Essentially, bonds are loans that you make to governments or corporations. In exchange for lending them your money, they agree to pay you back with interest over a set period of time. Bonds are generally considered less risky than stocks, which is why they're a crucial part of a well-diversified portfolio. They can help cushion your portfolio against market volatility and provide a steady stream of income. Now, here's the thing. In a low interest rate environment, like the one we've been in recently, bonds might not generate the same level of returns as they have in the past. But that doesn't mean you should write them off entirely. They still play a vital role in managing risk and preserving your capital. Alright, let's break down mutual funds. Now, mutual funds are like baskets of stocks or bonds that are managed by a professional fund manager. The idea is that these experts will use their knowledge and experience to pick the best investments and generate higher returns for you. Sounds great in theory, right? But here's the catch. Actively managed mutual funds often come with high fees, and those fees can seriously eat into your returns over time. In fact, studies have shown that the majority of actively managed funds actually underperform their benchmark indexes after fees are taken into account. So what's the alternative? Index mutual funds. These funds simply track a specific market index, just like ETFs. The key difference is that index mutual funds are priced only once per day at the end of the trading day. The beauty of index funds is that they take the guesswork out of investing. You don't need to pick individual stocks or try to beat the market. Just invest consistently, keep your fees low, and let the power of compounding work its magic over the long term. Let's talk about real estate. It's a popular investment for good reason. Tangible assets can generate income and appreciate. But buying properties is a lot of work. Managing tenants and repairs is tough. Real estate is illiquid and hard to sell quickly. Consider REITs for a hands-off approach. REITs own income-producing properties. They diversify your portfolio and offer passive income. But remember, real estate has risks. Now, let's talk about high-yield savings accounts. These are like the reliable best friend you can always count on. Even if they're not the most exciting person in the room, they're not going to make you rich, but they're essential for building a solid financial foundation. High-yield savings accounts offer a higher interest rate than traditional savings accounts, which means your money can grow a little faster while still being safe and accessible. The key here is to shop around and find a bank that offers a competitive interest rate. Now I know what you're thinking, Graham, the returns on high-yield savings accounts are tiny compared to other investments, and you're right, but that's not the point. High-yield savings accounts aren't meant to be your primary investment vehicle. They're designed to hold your emergency fund. That's the money you need to cover unexpected expenses like a medical bill or a car repair without going into debt. Okay, let's talk about certificates of deposit, or CDs. Now, CDs are like the time capsules of the investment world. You lock in a fixed interest rate for a set period, typically ranging from a few months to several years. And here's the deal. The longer you commit your money, the higher the interest rate you'll typically earn. Now, CDs are incredibly safe. Your money is insured by the FDIC, just like with a traditional savings account. But there's a catch. Once you lock in your money with a CD, you generally can't touch it without penalty until the maturity date. So if you need access to your cash before then, you might have to pay a hefty early withdrawal penalty. Now, in today's low interest rate environment, the returns on CDs might seem pretty underwhelming. But if you're looking for a safe and predictable way to grow your money over a set period and you don't need immediate access to your cash, CDs can be a decent option. Alright, let's talk about dividend stocks, the darlings of the income investing world. Now, dividend stocks are shares of companies that pay out a portion of their profits to shareholders on a regular basis, typically quarterly. Think of it like getting paid rent on your investment property. But instead of owning a physical building, you own a piece of a company. Dividend stocks can be a fantastic way to generate passive income, especially for retirees or those looking to supplement their income. But here's the thing, not all dividend stocks are created equal. Some companies have a long and consistent history of paying dividends, while others might cut or eliminate their dividends altogether if their financial performance takes a hit. And here's another thing to keep in mind, focusing too much on dividends can lead to missed opportunities for growth in non-dividend paying stocks. Okay, let's talk about peer-to-peer lending, or P2P lending. Now, P2P lending is like the Wild West of investing. It's a way for individual investors to lend money directly to borrowers, bypassing traditional financial institutions like banks. The idea is that borrowers get access to loans at potentially lower interest rates, while lenders can earn potentially higher returns. Sounds like a win-win, right? Well, not so fast. P2P lending comes with a whole host of risks. First and foremost, there's the risk of default. You're lending your money to individuals or businesses, and there's always a chance they won't be able to repay you. Plus, P2P lending platforms aren't banks. They're not subject to the same regulations and oversight, which means there's less protection for investors if things go south. If you're considering P2P lending, it's crucial to do your research, understand the risks involved, and only invest money you can afford to lose. And finally, let's talk about Robo Advisors, the tech-savvy sidekicks of the investing world. Now, Robo Advisors are automated investment platforms that use algorithms to build and manage your portfolio for you. They're like having a personal financial advisor in your pocket, but without the hefty fees. Here's how they work. You'll typically answer a series of questions about your financial goals, risk tolerance, and time horizon. Based on your answers, the Robo Advisor will create a diversified portfolio of low-cost ETFs that align with your needs. And here's the best part. Robo Advisors handle all the heavy lifting for you. They'll automatically rebalance your portfolio, reinvest your dividends, and make adjustments as needed to keep you on track. Now, while Robo Advisors can be a fantastic option for beginners or those who prefer a hands-off approach to investing, they're not perfect. Some investors feel that while Robo Advisors are convenient, they lack the personalized touch and expertise of a human financial advisor. There you have it, my friend. Our top 10 investments for beginners. Look, I know that getting started with investing can feel overwhelming, but trust me, it doesn't have to be. The key is to start small, diversify your investments, and focus on the long term. Remember, investing is a marathon, not a sprint. Don't get caught up in trying to time the market or chase the latest hot stock tip. Instead, focus on building a solid financial foundation that will allow you to achieve your financial goals and live the life you've always dreamed of. Now, if you found this video helpful, make sure to give it a thumbs up and subscribe to the channel for more awesome content. And as always, happy investing.